Thank you all for coming. So over the next 30 minutes, we're going to do a rapid fire discussion on impact investment and the kind of broader ecosystem of responsible investment that it's a part of. I'm going to do a couple of framing remarks just to set the stage so we're all on the same page. We're going to throw it over to our panelists who are going to shock and awe you with their brilliance. You guys are then going to shock and awe them with a few questions, hopefully, and then we'll wrap it up with a few next steps. So, started off, what are we talking about? We're talking about impact investment, which is the investing to generate a measurable social and environmental return as well as a financial return. It joins a broader ecosystem of responsible investment that includes exclusionary screening and proactive ESG alignment. You've probably heard about it. And every day there seems to be a new headline of major financial institutions that are coming into the space in some way, from BlackRock to PGGM to Morgan Stanley. You have the UK using its presidency of the G8 to try to catalyze a global market of activity. Even the Pope has talked about impact investing as a way to combat capitalism that often excludes and discards. There's been so much discussion that I half expect the world's most interesting man to say he doesn't always invest, but when he does, he chooses to integrate impact. And all of this matters, all of this hype, all of this growth matters because social and economic priorities are being reshaped. You have massive population growth to the point that by 2050 we'll need the equivalent of 2 Earths to be able to sustain ourselves. Resources are shrinking at the same time. An increasingly digital connected world. Climate change is a huge issue that's reshaping a lot of the corners of the Earth. And changing distributions of wealth. All of this is resulting in new kinds of investment opportunities, growing demand at the base of the pyramid, the rise of the virtuous consumer that only buys Patagonia or farm fresh salmon, and reshaping of government austerity. And so, as a result, a market is beginning to form. This comes from the World Economic Forum. It basically shows that there are capital providers, capital facilitators, and capital receivers. Everybody here represents some dot on this emerging market. The broader ecosystem, this is obviously not to scale, but impact investment sits around 60 billion. It joins sustainable investing, exclusionary screening, socially responsible investment. You can now look at ESG alignment on the Bloomberg terminal. So every advisor in the world can now hop on and actually see with publicly listed companies how they're performing. More and more folks are using it, skyrocketing numbers in terms of growth of issues and uptake. Even the CFA Institute, the kind of vaunted institution, is now saying that considering ESG issues, impact issues, will likely lead to more complete investment analysis and better informed decisions. Impact investment is now one of their key strategies within this broader world of responsible investment, and you have a growing world of folks that are experimenting with how to account for and measure and manage impact. So come down from traditional Guggenheim investments all the way up to UNICEF and Bridges, Sonnen Capital. So there's this new paradigm ahead, but oftentimes these new frontiers are a bit obscured. And I always like to end with this before I segue over. I helped to write a book called The New Frontiers of Philanthropy. I sent a copy to my mom, who is in a position to be an investor, works with entrepreneurs. She could be an impact investor. My book has become a fancy coaster for the Rod Stewart Great American Songbook. As you can see, the book is barely touched, but the CD has been worn within an inch of its life. She doesn't see her way into this, and this is true for a lot of advisors, money managers, and investors who are seeing this really crazy, complex world growing up in front of them, but they don't quite see their entrance point yet. And so that's really the thrust of this panel, is to get deeper into what is impact investment, why is it important, and how can you actually do it? So we have this illustrious panel. So I'm going to start off with Justin and Thomas. So when we think about what's motivating this interest in impact investment, responsible investment more broadly, Morgan Stanley and a lot of other studies point to millennials and women as kind of 2 key groups that are asking for this, really motivating interest. Is this what you guys are seeing? Is it different? Put a little paint on the canvas for everyone.
Thanks very much, Bill. Can you hear me all right with this ridiculous contraption? Sometimes I say that you are allowed to be a social impact investor over the age of 40 because apparently you're only allowed to care about society and the environment if you're a millennial. We all know that's not true. So yes, what we're seeing is that there's real investment demands now from the core market of retail investors who are people like you. They're looking for a proper return on their money, and they're also looking to achieve something consciously by the investment in the company, whether that's a pro-social or a pro-environmental, improvement in governance, improvement in research, education or health outcomes. And later on you'll be hearing from the managing directors of two members of the Social Stock Exchange about the ways that they're achieving impact in their businesses. But no, it's not just for millennials, it's something that you can do now.
Now, impact investing has to actually grow up. Otherwise, it's got every opportunity of turning into another fashion fad. And this year's fashion fad becomes next year's tank top, and an awful lot of investors lose money. No, fundamentally, people want to have a better idea of what they're investing in, how it's operating, and the returns they're going to be getting. They also want to be able to have a good proportion of their money, something which is not doing evil things, doing positive, good things as well. Our industry has been very bad at communicating with its clients. We provide shed loads of paper, we provide them with loads of online documentation, and still people are very unaware as to actually what their businesses are doing. They want to be more connected to it. It's their money. And just merely putting it into a dumb fund, or dumb fund with a list of things in it, is not good enough. So here is the opportunity, not just to provide a decent return for people, but to communicate with people so that they understand what their money is doing, to what it's going to achieve, and what return they can expect. If this is not done, then impact investing will just be one of those things you look back in 10 years' time and say, oh, that was another fashion fad. Make it credible as a real investment, and it'll get support.
And so maybe you guys want to weigh in, how are you guys making it credible within the operations that you're building? Maybe, and also everybody, if you want to say a few words about your actual function and what you guys are doing. We didn't do that part.
Thank you, Bill. Good afternoon, ladies and gentlemen. We are impact investors, so we are quoted on the ISDX market. We're members of the Social Stock Exchange, and we invest exclusively in employee-owned businesses, the John Lewis model. So we help to set up those businesses, we invest in those businesses, and we grow those businesses over the long term. Those businesses are better because those people have a stake in their company, and they are properly involved as if they are owners in that business. So we think we can demonstrate to real impact investment.
Yeah, good afternoon. I guess our thing is all based around the fact that every family has a health or social care story, and my family has one. I have a daughter with a learning disability, and many years ago I looked around and looked to see what actually was available, and I was really shocked at the money that was being made out of the sector, but not so much the money that was being made out of the sector, that the really poor quality of the sector. So we actually jumped in, and I believe that our sort of family values match social impact, and we now operate a very sort of specialist care home operation for people with very complex needs. We support about 80 people, we have about 350 staff, but importantly we have a model now which we've created over the last 12 years, which we can now roll out across the country hopefully, and we're now looking towards social impact investment as a way to actually fund that. It can be profitable and it can bring quality into communities, and it can connect with investors in those communities who can invest in actually those services for their communities. And likewise, we're a member of the Social Stock Exchange. Thank you.
Yeah,
that's what it is. A key issue here with this, and you were just talking about that, communities, is how you can then start reconnecting investment with communities in the region. This country has been absolutely useless at devising mechanisms to provide capital for business to grow. The London Stock Exchange has managed to shut down the mechanisms for local investing in this country. In 1945, there were 45 stock exchanges all around Britain, the primary purpose of which was not to keep silly gits in red braces happy. The primary purpose was to raise local money for local businesses. They shut it down, so we now have the London Stock Exchange, which is a fantastic operation that enables the Russians to invest their money very effectively, and does nothing at all for small businesses, and therefore that key point of connecting with the community is lost. The London Stock Exchange is failing here. We need a radical reform. This is a mechanism being able to do that, if it can be done. And I have to say, one of the initiatives that Thomas is doing is going to head that way.
Yeah, so that was perfectly teased. You have Thomas May talk about how Social Stock Exchange is helping to fill that kind of gap, bridge that divide.
That was an amazing intro. Also braces are in, again. One of the things that we believe is precisely that most social impact and environmental impact is local. Of course, there's one really good example of an environmental impact that's not local, which is climate change. But most impacts are achieved locally. So what we need to do is find a way for capital markets to finance social entrepreneurs on the ground where they're achieving those impacts. And that means bringing back the idea of regional exchanges which can connect local entrepreneurs to sources of capital supported by the community in which they're operating in order to achieve a return and, of course, to achieve an impact.
A classic case of that, of course, is with the burblings we get from some of our politicians about the Northern Powerhouse, which is a complete and utter waste of time in terms of having a mayor for Manchester or anything like that, unless it's got a mechanism for having capital. It's not going to be government grants, it's got to be EU grants. The money doesn't come off a money tree or a bunch of fairies. You've actually got to find money to be able to... There is no shortage of money. There's a shortage of process and structure to funnel the money from us as investors into local businesses to achieve the impact, social, but also in terms of financial and structural.
So that's right, it's a failure of intermediation.
Yeah.
And that's why we believe there should be an exchange in the Northwest.
Yeah. So can we talk a little bit about, if we're getting into this whole, that we are demonstrating this impact, that the accountability question, how do we know that the money is actually achieving all of these different ends? Maybe you guys can talk a little bit about your internal process or how you guys vet different funds that get on the exchange or different opportunities.
Well, the Social Stock Exchange, like any exchange, has an admissions panel that looks at financial due diligence. But we also have an independent admissions panel that looks for the social evidence and for the social beneficiaries and for a theory of change. So we ask the board of a company signing off the report by either its chairman or its chief executive to say what their theory of change is, how their business operates to achieve a social impact. We ask what their beneficiary group is, who they're trying to help, and we ask how they can evidence that they are achieving that in the course of their business operations. About half of the people who apply for membership of the Social Stock Exchange fail to pass the admissions panel. So it's a demanding challenge. It ought to be, because we have to be very clear that these people deserve our investment money and deserve our support. So with that, I'll hand over to the managing directors of two people who passed.
Yeah, thank you. we managed to pass, thank you very much. I think the key thing is for the future, it's really what you both touch upon, is that really social impact needs to define itself more, because it is in the process almost of being sort of hijacked by the VCs and so on. And certainly in our case, we're talking to a VC type fund, and actually they're not the people we want to invest with, because they're always looking for that last little bit. And actually you don't need that last little bit. You need to reinvest that last little bit back into the community and actually let the pond be a healthy pond, because we all eat, drink out of it and fish out of it and so on. And I think there is a lack of that sort of accountability, which is something that we have as an organization, because we relate directly to our local communities.
And allow people to have longer term investing, rather it's not just a short term, because your cycle is not 1 year or 3 years.
Absolutely. I mean, that's really the big issue, that, it's this 5-year cycle. I mean, we have groundbreaking sort of an IT platform, and we went to talk to a number of the VC type people about it, and they said, well, look, what the hell do we want this for? We're not going to be in the business in 5 years' time. And I said, well, Nokia, and I think that hopefully will sort of happen at some stage. But there is this huge opportunity, and it's not being taken, and it needs to be connected with.
I think from our experience, we invest for a minimum of 5 years. So we want the companies that we invest in, and they are across the UK and Ireland. We want to make sure the employees have the opportunity to buy shares in their company, to become genuine shareholders in those businesses, and those businesses are crucial to their communities. So they have an impact, and you can measure that. You can measure the impact in the company, and you can measure it actually in the community themselves. And those are about successful businesses growing in the long term, being there so people have got jobs for the long term, so they've got impact for their particular community, and we'll stick around for as long as they want us to be there. So, hopefully we can be part of this longer term social fabric.
Let's say there's another issue here, which is also the communication of this through to clients as well, to investors. Because we're still stuck in the world of, well, we have to actually put another report out, it goes online. And one of the issues that we've been looking at is actually trying to bring in the next generation of communication. And one of the areas we've been looking at particularly is actually using what software games writers do. People who write Donkey Kong and things like that, they communicate with the next generation in a completely different way. So actually have the mechanism so people can see what their companies are like, communicated to them in a way which they would understand, in a completely different structure, rather than an 8-page document, which means you're asleep by page 2.
Right. Well, so it sounds like that with your guys' different efforts that you're demonstrating the social and environmental impact. Let's talk a little bit about financial performance. You have all this data coming out of Wharton School of Business, Cambridge Associates, saying that these are really viable investments, that they are generating the kind of market rate financial return that investors typically expect. Is this what you guys are finding? I don't know. Maybe Thomas, you want to lead us off?
I think it's an extraordinary thing that in the last few years, this has gone from being regarded as something like charity, where if you're backing a business which has got any kind of social conscience, you're effectively making a decision to give your money away. That's been the perception. To where we are now, which is, this is probably the sustainable source of outperformance in your portfolio. All assets are correlated, everyone's passively indexed. No one is looking at this as a mainstream undertaking, and yet, just yesterday, the Governor of the Bank of England said, unless we can change the allocation of capital towards achieving the Sustainable Development Goals, we have no chance of achieving them. But he also said, this is where the real money is going to get made. This is what's going to lift us out of a slump and generate the economic activity we need for the country to grow again. So it's not philanthropy. It's about generating a return on your investments consciously with an impact that can be achieved as well.
So can I give you some illustration of that? So we're a quoted company. Just before Easter, we raised £1 million. And the Alliance Trust was one of the big institutional investors that came in behind us. So they are looking at this really seriously. They want us to grow up, they want us to be bigger, but they recognize that this is something that is here for the long term. So we have delivered a reasonable return on our share price and our investment over the last 2 years. So hopefully this is going to become something that's bigger and sustainable.
I think like there's another issue here as well, that if you actually apply the sort of wider concepts of social impact to the way in which you organize your business, in our case, we've managed to engage with our staff through collaborative working, and you're actually empowering your staff if those are your values. And what you get out of your staff are the solutions. And by doing that, you actually move things forward in a way that you couldn't under other circumstances do it. And it's this sort of shared belief that you're in this for the long term. And as a family, we've made the statement that we're never selling our business, it's a legacy business. And that really appeals to people because it does build that community, which again sort of builds on the collaborative working and the solutions.
So before I turn over to the audience, I know you guys are all sitting on 1,000,001 questions, so we'll get to those in a second. I guess a broader question, given that this is a conference for financial advisors, I mean, is this something that people can start to build practices around? Is it something that you can better connect with clients, make those relationships stickier? I don't know if you're seeing anything on the trend level at the kind of higher level.
Yeah, certainly when you're looking at financial advisors, they're now getting increasing demand from their users. What can I do to make sure that my funds are being used for the best purposes? What are the alternatives we've got into sustainability, the environmental elements? Give me the measures of your style of investing and what you're including. Where does this money actually end up? As well as actually showing me what the results are to it. If you're not going to be doing that, then frankly, you're going to be losing business. Right. So this isn't just a matter of, as Thomas was saying, this isn't charity. This is actually good business. A good business can make money, and investors want to be able to do that. So it's wholly logical. So long as it just doesn't get carried away and just comes into something which becomes rather ethereal, this is practical business being invested in by sensible people.
Right. Is anyone else?
I think it's, there's a regulatory requirement that financial advisors and discretionary wealth managers have to ask you, when they're advising you, enough questions in order to fill in a piece of paper, which means that they know their client. Well, one of the things that we're doing is lobbying the Financial Conduct Authority to say that when you're trying to find out about your client's investment purposes, why don't you ask if they care about investing capital in their local community, improving local amenity, improving the environment that their children and their grandchildren live in, go to school in, ultimately will have to work in and find jobs in and be educated in, because they probably do. And that probably will inflect their investment portfolio and decisions they take about which stocks they own.
Yeah, there's a couple of interesting financial advisory groups within Merrill Lynch, Morgan Stanley that are trying to equip financial advisors to really start to have this conversation. There's a lot of stuff around goals-based wealth. So that whole idea of I want to save for retirement, well, you think about outcomes as well in terms of the environment or society, and you can start matching these up. And so they actually have a whole framework now for it. But so go ahead.
But governments and local authorities can have a bigger view as well. There's this issue about, well, we don't have the assets around to be able to invest to make the infrastructure. That is untrue. If you devise, as we did with the privatizations years back, we were able to tap into huge amounts of private money for those privatizations. There's no reason why you can't do exactly the same with large infrastructure projects as well, to be able to develop that, bring that capital source in. The government says it can't fund it, right? Let's assume that. if you devise the right model, you could actually get private money brought into it, not through the large institutions, but actually through the private investor coming in. Not for all of it, but for a proportion of it. And that would allow local authorities, regional authorities, to be able to have access to carry out the development of that infrastructure at a much faster rate. We are incredibly slow at developing, well, we know the power structure, the transport structure, HS2, we've only just got the Penzance 1 back. The last one fell in the English Channel, for God's sake. To be able to get the communications right, and so there are the ability to actually harness that for the right proper resources. And surely this is logical. Our politicians do not understand it.
And I think the point. So I think the point basically is the word harness, because you're talking about people investing for their future, for their pension, but those people, the same people who are likely to end up in care homes or needing care support. So why not funnel that investment into good care home type investments, which also gives them some sort of preference to being able to actually go into that care home or to go in within that service. Now that's slightly simplistic, but there's no reason why that cannot be linked through, right the way through with local authorities. Yeah, but there is no connection. In the same way, it's very difficult to connect to actually raise the funds to actually go and do it. So the infrastructure is what's missing to a large degree.
I think we're at the finish line, so I'm going to open up for a couple rapid fire questions. Yeah, go ahead. Yep.
Thank you. It seems to me that the local enterprise partnerships might be expected to play some kind of role in this. Do you think they provide value for taxpayers' money?
It varies hugely. Some of the local enterprise partnerships are very good. They've got enterprise and they're partnerships and they're local. Others that look like sleeping dormice. Don't seem to do anything at all. They should actually be the group that should be harnessing and fostering this and saying, right, how do we actually get money raised locally, and how can we develop it into key areas, whether it's in local care home support or other infrastructure, and being able to foster it. Now, I know that Thomas has had some developments up in the northwest, haven't you, to be able to get some support there. I don't know if it's from the LEPs or not, but they are the sort of groups that should be doing it. The question is the quality of the people in the LEPs. I don't want a bunch of leftover bank managers.
All right, we're going to go 2 more questions. Anybody? Go ahead.
Thank you. What defines a company that one can invest in? For example, Capital for Colleagues. What is the type of company that you can invest in?
And we'll do one more question if there's one other one, or we'll just end it there. All right, go ahead.
So we are a quoted company. We're quoted on the ISDX market. We're a bit like an investment trust. So you can buy shares in our company. We use that capital to invest in the employer-owned businesses that we focus on. So there are plenty of brokers on the ISDX market that will be able to sell our shares.
And yeah.
Is it on? Yeah.
Can those companies be profit-making companies?
They are all profit-making companies. They are all profit-making companies.
So I think we've hit the finish line. We'll do a quick kind of, what's the key takeaway that you want everyone to walk out of here with? And we'll start with Thomas, because you're the ringleader here. So
the thing I want you to think about when you walk away from this is that this is something that you can do. This is a huge opportunity to invest in what is going to be the infrastructure for the next generation in this country. And I want it to be owned by the general public and not by private equity. What we need is public equity, and that means you have to participate.
Okay, all your investments, I believe you have to get much closer to understand what's going on, particularly if you're using an advisor or discretionary manager. You're not just giving them money into a lump sum and it disappears into a pot. What's it invested in, why, and what returns, and how it's actually achieved? Is it fulfilling your actual goals? Don't just believe what the industry is telling you in terms of this blob, and also, how much is it costing you? Because as far as I'm concerned, I look around the industry, I see all sorts of different charges being put on, labelled on people, some directly, some indirectly. It's your money. If you were looking around for different banking or different services from your electricity or gas providers, you would actually shop around for a good value. Do the same with your financial services as well to make sure you don't just get the right price, but you get the right style and type of investment that you want.
I think what I would give you to take away is don't actually believe what's printed on the can, because you don't know what's actually in there. And don't assume that because something's in a third sector or something's in in the private sector and they're doing the same thing, don't naturally believe that the third sector is the better sector that's doing it, whereas it could be the private sector. But nothing is necessarily the way it seems. So it is a jungle out there, but it's worth actually digging much deeper to find out what the reality is.
Our social impact is through employee-owned businesses. So today, 30 billion pounds of the UK's GDP comes from employee-owned businesses. By 2020, we want 10% of the UK GDP to come from employee-owned businesses. Please help us do that.
Thank you, guys. Please welcome me and or give a hand of applause to the panelists. Social Stock Exchange has a stand over there, stand number 9. So feel free to come over and say hi.